This is a down day. We've seen them before, but does this one feel different than other down days, given the fact that it's being triggered by maybe arguably one of the Mag 7, if not two of the Mag 7? And then, Jim, I'm going to start with you on this one here.
Well, I mean, okay, it's a down day, and I get it. Alphabet's down, and some people are worried about the capital expenditures. I'm not. I would also point out that as far as down days have gone recently, it's nice to show a little bit of sign of strength in something like Micron. Some of the memory chips makes sense, right? If CapEx is going up at Alphabet, if they're not throwing in the towel because of Chinese open source large language models, then okay, it's game on for spending at Micron, which of course they have those long-term contracts in place. Look, I get it. There are people who are worried that AI is a bubble. I certainly understand that. I'm more in the camp of the CEOs of these hyperscalers, the Brad Gerstners of the world, who all feel that at worst we're in the middle innings of this. And yes, I get it. Political blowback against data center construction. Some people don't want them in their backyard. There's enough places to build these things, and clearly from Alphabet we're going to continue to build them whether we like it or not. So I don't look at this as a bad sign. I look at it as the AI trade is alive and healthy.
Josh, you either have to spend the money, you got to spend the money, right? Because you position yourself for future growth, or you don't spend the money and are not positioned for that future growth down the line. It seems like a bit of a paradox. Is it one that is overall constructive over the medium term? Long term, we know it is. That's the future of technology. But short to medium term, how exactly then do you reconcile the paradox about spending versus positioning for growth down the line?
Okay, so two different answers to your question. And I know I have all the time in the world, right, guys? We're good?
Yes.
The first answer is I've been talking about the second half as being a totally different environment from the first half. And in the second half, I think you want to focus on non-hyperscalers that are seeing business improvement in the form of upside earnings surprises as a result of their uses of AI. I like this story so much better. This whole broadening out trade that we're living through in the markets, this whole shift away from Mag 7, from hyperscaler, and into other sectors, other areas, is being driven by this idea. There are companies that are demonstrating material progress in incorporating all of these AI tools that Alphabet and Meta are paying for, and they're able to tell the street, oh, by the way, this earnings beat sponsored by our use of blank. Name your favorite LLM. So I've given two examples for the viewers on this show. Recently, I've been pounding the table on Travelers. Let's go ahead and put up a chart here. Bright green in a dark red tape. It's not a secret as to why. Here's Chubb. We talked about this Tuesday. CB, another situation, insurance, just absolutely ripping to the upside. You talk about the companies that are going to feel the efficiencies and the productivity from AI use first. These have to be at the top of the list. Then you look at the industrials. I talked about Alphabet the other day as being literally the key to the market. What could resurrect this AI trade? It's going to be the CapEx number. Google took its CapEx number up by $5 or $10 billion. Good enough. Look at the industrials today. The best performing sector, Caterpillar up 1.7%. GE is up. GEV is up as well. And when you've got the industrials reacting positively to a game-on announcement from Alphabet, you look at this market and you say, okay, I don't need to worry about whether or not the hyperscalers hold up. I have so many other ways to play what's going on.
Malcolm, the overall feel in the market right now has been for weeks this idea, and we all go back to the same chart about how much money the hyperscalers are spending out of their free cash flow and how much of that is being transferred to hardware companies that have to build AI infrastructure. Sure. This is a trade right now, though, that, to Josh's point, benefits way more companies than just the select maybe 10 or 15 at the top of this kind of Mag 7 hyperscaler type food chain. Is it one, though, where if you look at these sectors overall, you have to be even more specific about what parts of those sectors and what industries specifically are going to be the outstanding beneficiaries of this, as opposed to just the kind of market beneficiaries?
Yeah, it's absolutely a stock picker's market. Josh is pointing out there are companies with green on the screen, even as the market seems to be selling off writ large today. This is an important moment to be paying attention to which companies are showing up green. But separately from that, I was on last week when Shannon said it's a tough quarter to have a tough quarter. And I think that is being proven true right now for a company that was already trading at a decent premium to the market, something like 24 times earnings. to then turn around and have a second miss in a row. The last thing that the street wanted to hear is, and oh, by the way, we're going to raise the top end of our CapEx target by about $15 billion. I think that what Google has proven is that they are not going to be the first one to blink in this hyperscaler CapEx arm race. But I think what investors are looking to hear, what the analyst community is looking to hear, is really where the tangible benefits of this CapEx is going to be in layman's terms. We don't necessarily want to hear about the huge projections for by 2030 this thing will be. We got that in the form of increased growth in Google Cloud, which I thought was very positive. They increased growth there by about 20 percentage points above what they did last quarter, which was massive last quarter. So I think they are working it out. They are proving the bull case for why you'd want to be invested in the companies doing the spending, at least for Alphabet. But it's also going to be a while before that one starts to really go in the other direction. But, you know, it's up 70% still with today's pullback over the last year. Maybe there's a reason why folks are taking profits. Nobody ever went broke taking a profit.
So Alphabet, by the way, to put points on this, sequentially, you talked about the massive move higher in cloud revenue. It's even more impressive on a year-over-year basis. It's up 82% year over year. We've also got their CapEx guidance, of course, being raised. Let's talk about, you mentioned the analyst community. There are a handful of moves that are happening right now. JP Morgan did reiterate its overweight rating on Alphabet in light of these earnings, but they did cut their target price by $40 to $420 a share. Piper Sandler cut their target price as well, but then reiterated their overweight rating. Piper Sandler says the 2Q26 results were largely in line with our expectations, but cloud materially outperformed, accelerating 82% year over year. Shares fell 4% after hours as management raised its CapEx guide and reiterated plans for a significant increase in 2027. A handful of other analysts are out there doing this. And Jason, you're a shareholder of Alphabet. How much do you care about what some of these projections by the company itself are, and then what the analysts are projecting the repercussions could be for share price down the line?
Yeah, I think the key is obviously the reiteration of overweight, right? I mean, some price pullback, that's fine. I mean, the stock is roughly flat. It's up 2% so far this year. They had to raise it and reaffirm and raise the CapEx guide from my perspective. I think the street also is looking at the operational margin miss. I mean, it's by 2%. I think the expectation was 36. They came in at 34. You know, I think that's a bit of a concern. And then negative free cash flow. Again, we got to continue to raise capital, whether it's secondaries or debt offerings, to continue to spice up the chain, to be able to reinvest and get these LLMs to a level where there's true enterprise adoption. So I think that is the story. I think we will likely see a read-through to Amazon and some of the other hyperscalers as a result of some of the spending. Once one makes a move like this, the others will follow. And that is, you know, somewhat concerned. But to Josh's point earlier, the story has to be about the breadth, the AI beneficiaries. To Jimmy's point, Micron moving today. Unfortunately, we're seeing energy move a lot today for other reasons. But, you know, we need to see other sectors continue to play in this bull run, industrials, financials, healthcares, which we've seen over the last couple of weeks. I think we need to continue to see that to overall see a healthy market going forward.
Tom, I just want to point out one thing. All right, this may
By the way, Jim, you're a shareholder as well, so I'm kind of curious what you thought.
And as a shareholder, a long-term shareholder, obviously I'm not happy down 6% today, but I've got to put it into perspective of over the last year, it's up 67%.
Right.
Over the last year, the value of Alphabet, the company, is up $1.2 billion. Like it can take a breather. The way that it got that much appreciation is because a number of earnings reports that came in much better than expected. And when you get those reports a year ago, 9 months ago, you say to yourself, it's not going to last forever. Right. What's happened this quarter is very understandable, particularly the negative free cash flow. If you don't believe what I said earlier about this is the middle innings of AI, this is not the stock for you. I get it. Or maybe like Josh said, you've got a bunch of derivative plays elsewhere of where artificial intelligence is going to help out. But I'll tell you, my own opinion is that this is an easy stock to hold over the next year. Maybe it takes a few days, a few weeks to kind of digest this earnings report, but there's going to come a point in time, probably not that far away, where money starts flowing into the hyperscalers again. Amazon, Alphabet will benefit.
Two things happened during the course of this quarter. One is it wasn't horrible, but search was not as good as expected as a specific line item. Right. I wonder if you view that as potentially now something to monitor going forward, because cannibalization of search was always a negative hanging over Alphabet. It ended up being much ado about nothing because they went all in on AI responses to queries, and the profitability was okay. But I'm just curious.
Yeah,
and then the second thing, look, this is a company that had been buying back stock for most of the last 10 years. And during the course of this quarter, they came out and surprised everyone with an at-the-market equity offering. Do you think there might be another one during the course of this quarter, given what they're saying about CapEx? And is that now something that maybe materially changes the story?
I mean, good questions. The second one first. I mean, certainly they could. I don't think they would want to. I know the debt market is pretty saturated right now, but the cost of equity capital is a lot higher for Alphabet, in my opinion, than debt capital. So I'd rather have them do that. Yeah, they did the secondary, got some cash in their hands, fine. Where this all comes down to, Josh,
it was not small.
85 million. But where this all comes down to is they are investing. And as I said, you either believe the investment is going to pay off or you don't. If you don't, then obviously you're not owning Alphabet. I'm not going to dare anyone to short it, but if that's your, if that's your cup of tea, go right ahead. With regards to your other question about search, I kind of saw it close enough to call it in line, but okay, instead of debating that, what I think is more interesting is what AI Overview is doing to a number of publishers. There's some reports on this. Alphabet may have to figure out some ways to compensate the Reddits of the world, the Fortune magazines of the world.
Or get sued into the Stone Age. Right.
Well, I mean, I'm not sure those lawsuits would have any real legs to it, but it's probably better to just co-opt that and get a better revenue sharing agreement in place.